Greetings, I'm Andrew Ludwig, and welcome to Black Onyx Alternative Investments, where we bring you face-to-face with South Africa's most talented boutique asset managers and industry stakeholders. Why do we do this? Because we believe that you, the investor, deserve to be better informed so as to achieve the best risk-adjusted returns. Today we are speaking to Cy Jacobs. He's the co-founder of 361 Asset Management, which was established in 2004. Cy, thank you very much for joining us. We look forward to learning a bit about your fund. Tell us a bit about your background and how you got into alternative investments.
Absolutely. So I've always had a love for the market from when I was a teenager at school. Myself and my best friend took to investing in the JSE very early on, probably at the age of 16. He had a father who had quite a large share portfolio, and we learned the tricks of the trade at school. Initially started our own portfolio, which never turned out so good. By 1987, we were caught up in the big crash, the Blue Monday, as it was known. And from that day on, always been fascinated with everything. So went on, did a course in obviously stockbroking, but actually became a chartered accountant. Did my articles and met somebody, my current business partner, Steve Lips, met him during articles. The end of articles, we went on to become private client stockbrokers at HSBC, sold our business a few years later to Investec. When joining Investec, loved the idea of hedge funds, tried to play around a little bit at Investec. They weren't big lovers of the strategy, and we launched our own company in 2004 to effectively start a hedge fund business.
Tell us about your firm and some of the funds and strategies that you represent.
So the firm started in 2004. Myself and my current business partner, Steve Lips, came both out of Investec. We just had a philosophy. We want to look after private clients in a very flat structure. We wanted to manage their money to the best of our capability and not tie ourselves up in red tape or bureaucracy of all the bigger institutions. We set out just to look after a handful of clients, and this has obviously grown into a much larger business. Today we have some 18 people, just short of 20 billion in assets under management. Approximately half of that is hedge funds, the balance being long-only money. And the strategies are really simple. We have a long-only strategy, which effectively is an equity strategy, which is our best selection of equities, which we hope over time to beat the market. And then we have a hedge fund strategy, which effectively culminates with the exact same portfolio from the long-only side. But then via our research techniques, we come across many short ideas which effectively supplement the long-only portfolio, also bringing down the risk of that long-only portfolio, and do various option strategies, etc., to bring down that risk further. So really a simple approach, one investment process, a simple, really flat structured business with a small amount of people, no hierarchy, no titles in the business, and in fact not even any marketing people. So all business really comes by word of mouth, by people hopefully trusting our performance and being there for some time, and really having sown the seeds of some great performance over the years.
Please give me your definition of a hedge fund, a short explanation on short selling, and a bit of detail on how alternative strategies capture the alpha.
Okay, so hedge fund definitions in themselves are very wide. If you went offshore, you'd find a hedge fund can trade in almost anything. Because it's unregulated, the word hedge fund often scares many investors. In the South African context, hedge funds have become regulated. So they now are regulated just like collective investment schemes or unit trusts. So the definition of a hedge fund in South Africa is a lot more closely or with much stronger and stringent barriers than it would be offshore. Hedge funds in South Africa are effectively just extensions of what you do in unit trusts, but can do other types of investments. So if I compared the two, in a unit trust you'd have a long-only fund which effectively just buys various shares that it likes. In a hedge fund you do exactly the same, you'd buy exactly the same shares. In our case we buy the same shares in the hedge fund, but then we also find shares or equities where we do not like the investment case, and we decide to rather borrow those shares, which is in fact the short selling question. So you borrow those shares from somebody who owns them, and then we effectively sell those shares in the market. So we'll have a portfolio of short shares, which are shares we've sold that we don't actually own, which at some stage later in time, we have to buy those shares back to deliver them back to the rightful owners. But in the meantime, those short shares are effectively acting as a buffer against your set of long shares. So your set of long shares have got a lot of market risk. So if the share market had to fall down, let's say 5 or 10%, you would expect more or less your long portfolio to also retrace 5 or 10%. But at the same time, you've gone short a basket of shares, which in fact you will make money from if they were to fall further, as you never owned them. You just sold them without owning them. That would offset a lot of the market risk of your long-only portfolio. So effectively, that is effectively what is known as short selling. Over and above that, in our type of strategy, we look at measuring exactly what the long-only portfolio versus the short portfolio delivers from a market-related risk perspective. So let's say in a normal course of a year, the stock market had to fall 10%. We would measure what all those shares that we own would in fact do in a 10% type movement, and let's say they did lose 10%, we would then want compensating short shares that would hopefully deliver us close to 10%, either with the individual shares or with various derivative option structures that we may put in place to ensure that we can protect this long-only portfolio for bad market times. So that's really how the hedge fund works. The short selling is actually very simple. It is as if you were selling shares that you did own. So it's not a very complicated procedure. It's all electronically done. So today it's actually the same as selling the shares that you own or selling the shares that you don't own. The process is actually very much the same.
How exactly is your fund different from other mainstream products and alternative investments that are out there?
So our fund is really not extremely different from everybody else, except that our focus is very much on mitigating the risk that the market brings to the portfolio and to any normal portfolio. So in any general portfolio, you're always at the mercy of the markets. You're at the specifically in South Africa, you never know what political turmoil or changes to currencies, exchange rates, etc., what could happen. So our fund really looks to try and protect from all these macro events and tries to protect itself from any rather big movements in the market. How we do that is obviously having a long portfolio which you believe in the long-term prospects of, having the short portfolio which acts as a buffer against that long portfolio, which is pretty common with all long-short hedge funds. But then again, we try and measure exactly what our net beta, what our market exposure is to the market, which is a precise measurement which can be attained. We then look to buy various derivative structures to try and protect that net beta exposure that we have in the market. And our focus is not more on what we can make on this investment or what we can lose on that investment, but trying to get the whole portfolio to very close to a beta neutral portfolio, something which will not move heavily or not be exposed over time to various vagrancies in the market.